Coming off a week where we saw about 3.8% off the S&P ASX 200, a fall of 0.5%, not that bad?
It's not that bad, but it still represents the fifth consecutive day of decreases on the Aussie share market, and that's the longest losing streak that we've actually seen since July last year. And since July last year, the market's actually been up by 22%. So to put into context, it's been a great run for the Aussie share market. We peaked for the year on the 15th of May, and that was at 5,246 points. So that was around about 2 weeks ago now, and it represents a drop of 5.4%. So we had been hitting 5-year highs on the Aussie share market, and now we are seeing a correction of 5.4% so far. Japan is a major factor, I think, and in Japan I think we are seeing a bit of a shift, and I guess the key here is that there is a lot of retail participation in investment markets in Japan, and of course with investors being squeezed out of the Japanese bond market, a lot of them have gone into the equity markets, and that's because of the very strong performance we've seen. In the last 1 year, Japanese shares up by 72%, this year alone up by 50%, and now we're seeing this experiment with the Bank of Japan, and I guess a lot of nervous investors just being a bit cautious in terms of the Japanese stock market. So the Japanese stock market down 3.4%, and that in turn I think had an impact on markets around the region. So despite it being a holiday in the US as well as the UK tonight, we actually saw some pretty good volumes going through the Australian share market for a Monday. Usually on a Monday we expect to see about $3.5 billion worth of stock being traded, but it was like a regular trading day on the Aussie market. The other thing we've been talking about for a while now is the impact of the Aussie dollar. I mean, it's great news for Australian investors who are invested offshore at the moment, but if you flip over the argument, international investors who are invested in Australia, it's not looking so good for them, because while they're invested over here, they actually want the Aussie dollar to rise, not fall. So we're probably seeing a bit of international participation pulling out funds with that lower Aussie dollar, and the forecast for an even lower Aussie dollar that we've talked about numerous times still having an impact. But all in all, the extra volatility that we are seeing from the Japanese market having an impact here as well.
So just so I'm clear, so I'm still a little bit muddled as to what is driving the volatility, Julia, in Japan's market. Is it retail investors over there taking profits, and is there also a degree of foreign investors taking their money out because of yen unpredictability?
I think it's a combination at the moment. I think we're seeing retail investment shifting funds. We're also seeing institutional funds maybe just taking a view on the macro outlook for the globe at the moment. So we're probably seeing a bit of macro positioning. And of course, the currency is a major factor. We've seen a massive shift in positioning in currency over the last 2 weeks. And part of that has been the US dollar strength, the Aussie dollar weakness, and of course the impact against the Japanese yen with all of the stimulus coming out as well. So I think currency is a huge factor there, but I think we're also seeing sort of macro positioning happening, as well as retail investors being quite jittery over there as well.
Turn it around. Are you confident in the outlook? Did you get much from Paul Zahra today to fill you with confidence in its outlook?
I think there's a few things to watch out from David Jones. First of all, as already mentioned, you know, the like-for-like sales was extremely disappointing, a drop of 3.4%, but then the focus on margins is quite positive, the gross margins. However, if you have a look at what the competitors are doing in that space, there's going to be much more discounting involved, and how DJ is going to avoid discounting heavily when its competitors are already doing that remains to be seen. So is this going to be a strategy that works in terms of the market? Having said that, if you're investing in a retailer, you know that it's a cyclical business, and you really want to be buying when the price is quite low and selling when it's quite high. And if we have a look at cyclical business, you would have to say that retailing is at a cyclical low. The flip side of this is that, you know, it's been at a cyclical low for a while now, so where's the turning point going to come from? We've seen from stocks like Harvey Norman, though, once we do see a reversal in that like-for-like sales going from negative to positive, we can see a big uplift in terms of the shares, and at the moment we're seeing DJ's like-for-like down by 3.4%. If in the next couple of quarters we see that trend improving and indeed turn into positive territory, that could be a catalyst for the stock. So the numbers didn't look good, the focus on margins is good, but have a look at the competitive environment as well, and we're really watching that trend, and you want to see that inflection point and see that trend turn from negative to positive, which I think would be a catalyst for the share price to move quite big.
Sorry, Julia. Michael, is this a